Welcome back to Market on Close. We have just a few minutes left in our trading day. That means it's time for the big picture. We'll welcome in our team from Charles Schwab to do that. Joining us is Liz Ann Sonders, our Chief Investment Strategist at Charles Schwab. Liz Ann, thanks for being with us as always. I'd first just like to start with your thoughts on today's action. You know, we're seeing yet another record for the NASDAQ.
Yeah, so the momentum trade is still in full force. This has been an interesting move off the early April lows. Has had a lot to do with the retail trader. You can see that in the various cohorts that have not only done well but have outperformed the S&P, inclusive of not just tech broadly but non-profitable tech. That's one of those retail trader fingerprints, but also retail favorites, and a lot of the heavily shorted categories have done well. In addition to those other categories. And what's interesting about that is it's suggestive of retail traders having kind of initially powered this move higher and then to some degree maybe forcing some short covering on the part of institutions that are still not positioned in risk on mode. So I think the pain trade is probably still a little bit higher from here.
Yeah, and as we continue talking about this, I went through your notes, and you know, you made an observation that the economy is becoming more K-shaped. You know, where are we seeing the strongest and weakest recoveries here?
Yeah, so I think if you look at the economy and the bifurcation, it's at a number of different levels. You can look at it in income levels, and you've got much healthier background for higher income folks versus lower income folks. You're starting to see that bite happen in consumption data. You're even seeing that within some of the inflation data. From a CapEx perspective, you've got more traditional CapEx largely on hold as a result of trade policy related uncertainty, but anything AI related seems to be full bore. And you're seeing that to some degree within the equity market too. More dispersion, more differentiation in terms of the haves and the have-nots, even in small cohorts like the Magnificent Seven, which really has become more the Mag 3 because only 3 of the 7 stocks are outperforming the S&P. So I think it does require more fine-tooth combing to get a true sense of both what's going on in the economy, but also in the market.
And what do you think is driving those divergences, you know, particularly within the Mag 7, who for a period of time were reliable to sort of move in tandem, but like you said, it's the Mag 3 now?
Well, I think it's been well noted maybe what some of the reasons are behind the underperformance of a stock like Tesla, but I think it's also who's really at the heart of the spend, of the resilience that AI related, and that's why you see. I think of it almost to the way to remember. By the way, a little hack here is the middle of the alphabet within the Mag 7 are the ones that are outperforming. So Nvidia, Meta, Microsoft, and it's the ends of the alphabet, the Apple, Amazon, and Alphabet, Amazon. What am I forgetting?
Google.
Alphabet, Amazon,
Tesla.
Apple, Amazon.
Tesla.
Yeah, and well, Tesla on the other end of the spectrum. Yeah. So I think that when you've got a tougher market environment like we had into the early April lows, you tend to see dispersion come down, correlations go up, everything sort of gets hit. Yes, you had tech and the Mag 7 hurt disproportionately because of the necessary valuation adjustment. And then when you start to see the market move higher, you get a bit more dispersion. It becomes a little bit more of a level playing field for active managers because you tend to reconnect fundamentals with prices. And I think the fundamentals that matter right now are things like, are you impacted or not by tariffs? Are you benefiting from the AI spend, which is full bore, versus the policy-related constraints on other segments of CapEx? So I think that's one of the broad ways to think about some of these differentiations within the market.
And Liz Ann, before we have to say goodbye, I want to get your thoughts on the Fed as we're getting some more inflation data and also the new discussion of potential Fed chairs and a potential firing that was shut down yesterday.
Yeah, I mean, there was a little too much hyperbole yesterday. Market plunges when that threat was initially discussed. Yes, it did turn, and I think that was a signal. But I think that there is some complacency here too. That okay, we'll just assume that the market will dictate what the administration, how far they're willing to go. Unequivocally, I think any significant overt political pressure on the Fed is not a good thing. Let's also remember, though, regardless of who ultimately is appointed to be a shadow Fed chair or take over for Powell when his actual term expires as Fed chair next May, is that the C in FOMC is committee, not chair. So you would have to control all 12 voting members, not just the chair. Yes, she wields influence, but it's not as simple as just putting somebody in that can then take marching orders from the White House. It's just not the way the structure of the Fed works.
A very good point there, Liz Ann. Thank you for striking that for us. That's Liz Ann Sonders from Charles Schwab. We appreciate you being with us as always.